Well, hello everyone. Welcome to Getting Started with Options. Today we are back to week one and we are going to talk about the basics. And what do I mean by that? Well, with options, we have two different strategies. Not two different strategies. We have two different types of options. There are calls and there are puts. And at the end of the day, you can do one of two things with a call. You can buy it or you can sell it. And the same thing with puts. You can either buy or sell a put. So we are going to go back to the beginning and look at what it means to buy and sell puts and calls. Now, you may be saying, I thought this was a 12-week series. And if we can only do, buy or sell a call and buy or sell a put, why are we taking 12 weeks to do it? And it's because once you understand the basics of what it means to buy and sell calls and puts, we can put them together in all kinds of different patterns. And some, of these strategies, and we're going to cover 10 strategies over our 12 weeks together. Some of these strategies work really well when the market is going up. Some of these strategies are designed to work well when the market is going down, or when a particular stock is going down. And we're going to look at stocks that are both going up and down today, even though the market has been very strong. And then there are some strategies that are designed to work well when the market or a particular stock is going sideways. Now, one thing about options is that even though they may be designed to work well when a stock is going in a certain direction or an index is going in a certain direction, there are risks, and it's important that we understand those. So, are you ready? Because we are going to get right down to business. So if you are not following me on X, consider this an invitation. My handle is at Barb Armstrong CS. We also have Cameron May with us in the chat today. And I have my chat up here to my right. Cameron is a friend and a fellow coach, and he really understands all of this stuff in spades and then some. So if you have any questions, please don't hesitate to ask. I will glance at the chat on occasion and answer questions as we go. Somebody's asking if this is a poppy. Yeah, this is, Canadians wear poppies the entire month of November. And when you go into like a Costco or any type of big store, and often just in the downtown areas, there will be people selling poppies. And it's in Canada, we call it Remembrance Day. In the US, it's Veterans Day, but it's to remember that freedom is not free. And I saw a British show the other day, and the host, it was kind of a talk show, and the host was wearing poppies. So it's probably one of those things that the Canadians got from the Brits, and we just, we continue to do that. So yeah, so there's the poppy thing. Okay, let's get right down to business, because I am going back to my napkin drawing thing. And I'll explain that in a minute, but it takes us a hot minute. Okay, so know that options carry a high level of risk and are not suitable for all investors. We're going to spend a lot of time talking about risk and reward today. And so, that's a great reminder. When we look at, I just want to make sure. Oh, there we go. I wanted to make sure that, I had all of these important bits of information up there for you to see. We use the paperMoney software application on the thinkorswim desktop platform. It is a great place to be able to learn. And if you want to learn a new trading strategy, this is a great place to come. Make sure you understand the strategy, what happens when the trade goes for you, or perhaps as importantly, if the trade doesn't go your way, make sure you understand the mechanics of how to use the platform. Make sure you understand the trading plan that you're, planning on trading, all of these things. And so we use paperMoney extensively here, with Schwab coaching. So without further ado, I want to keep us moving forward, and we're going to look at why traders use options. Well, some of them use it as a means of protection. Maybe you have saved and invested a lot of money over time, and as I like to call it, your giant heap, you'd like to protect that heap. So over our 12 weeks together, we're going to talk about some strategies that, option strategies that some investors might use to protect their positions. Some might be looking to generate income. Maybe you're now in retirement or maybe not, but maybe you would like to be able to generate a weekly or monthly income, and dividends are just, they can be part of maybe your goal to generate income from your investments. But there are some that will use option strategies to generate income. And so this is a reason that some people might look at options. And then, I find the word speculate, that can have a certain connotation to it, but I like to use the word growth. So instead of saying to speculate, maybe the goal, whoops, I've got to erase this. Shades of what is to come, my friends. I was practicing that ahead of time. We might be looking here simply to grow your account. So we might look at this for protection, for income, and for growth. And so these are three of the reasons that traders and investors might consider using options. And, we're using to just grow the account. And I teach a class called Trading a Smaller Account. And so we use a lot of options in that class. And a lot of the trades we place are for either income or growth. We start with 20,000. And so, we do use protection on the trades that we place, but we don't have a giant heap yet per se to protect, but we also don't want to blow up our account. So we're very mindful of all of that. Okay. So take risks that can, end up really hurting. Okay. So let's go on. Now, a lot of people, and I've talked to a lot of people, and I teach this stuff, and they're just saying, I would never look at options. They are way too risky. Well, I understand what you're saying when you say that, but sometimes people make comments and they don't really understand what option strategies are. And yes, they can be risky, but so can stock ownership. But, when we buy a share of stock, we now own that stock. We can keep it forever. There's no expiration date. It costs more. Well, cost is relative. You're controlling, if you buy 100 shares of something, you're going to spend more or invest more than if you buy a long call. But a long call, when you buy a long call, you don't own it. And that long call has an expiration date. So it might be 30 days from now. It could be 300 days from now. But there is an expiration date. And it costs less, and you control, the movement up or down of that. You can benefit from the movement up or down of the stock. But it's a time limited thing. You don't own anything. And because you don't own the stock, you're not being paid any dividends. So there are pros and cons on both sides. But I want to just reiterate that there's risk in walking across the street, but there's also risk. And sometimes I think people don't take it into account in owning a stock. If you go with a buy and hold strategy, and I'm just going to bring up the thinkorswim platform before we kind of get into the options. And let's look at Peloton. And, in the last few months, Peloton has come up. It's now trading at $8.97 a share. Back here in August, it was down at $2.83. But if we look at a 3-year chart on Peloton, and in fact, let's go out and look at an even longer time frame. And somehow my list got kind of when we look at the last 5 years, if you had, when the pandemic hit, bought Peloton, you would have felt pretty brilliant because it really went up nicely and ended up topping out at $171. But it has had a great fall, hasn't it? Like it's now trading under $10 a share. And so there are risks in everything that we do in the market potentially, and Weight Watchers was at one time, if we go back 10 years, it went up to $105 a share. It's now trading at $1. And that was in 2018. So in 6 years, this thing has lost, 99% of its value. And so, it's important to understand and have rules around how you trade, whether it is a stock trade or an option trade. And I don't say that, to scare you, because then you have stocks like NVIDIA, and let's go to a shorter time frame. Geez, we could look at a 3-year. This thing is up 1,100% year to date. And when we look at this stock has gone from, and this is, from the equivalent of $10 a share, up to 149. So there can be tremendous gains also. Okay. So I just wanted to, you know what? This year to date number is only valid if you're on a daily chart. So let's just go to year to date. Sorry, it's only up, it's up 199%. And that's not too shabby. Yeah. Yeah, Weight Watchers did lose a lot of weight. Okay. So back to our PowerPoint. So I've got a blank screen. And for those of you who have gone through this series a couple of times, this is my, I'm new to options. I find them a little confusing and I want to figure this stuff out. And so here's my challenge to each and every one of you. And if you feel like you've really got this button down and you totally understand all this stuff, first of all, kudos to you, because there are times I think I still, just a sec. I'm doing some stuff on the side over here. Okay. So we are just going to take and draw a grid. And so my challenge to you is that, you grab an envelope, that's sitting on your kitchen counter when you're having your morning coffee or whatever beverage you like to have in the morning. And you just quickly draw this grid. And, like I said, with options, we can only do a couple of things, right? Oh, you know what? Just a minute. I'm going to have to start this over. Hold on. Because I've got something over here I want to be able to see. Just one sec. Okay, here we go. Okay. Appreciate your patience, guys. Once we get going, you'll see what I'm doing here. So to just grab this, grab a piece of paper and grab a pen and then draw a quick grid. Okay, and then how many columns do we want? We want 6. So here's our first one. Second one. Well, that's our third. This is risk reward. Time. Draw it out and you may think like, oh my God, what is she doing? Well, this is what we're going to do. We're going to fill this out. So remember I said we have, we have calls and we have puts, and we can either buy a call or we can buy a put. and then we can sell a call, or we can sell a put. And we can put these together in different combinations, but at the end of the day, you have to understand what it means to buy a call and to buy a put. And you have to have an understanding of what direction you think the stock is going if you want to use that strategy. Then we're going to look at risk and reward. You know, how much can you lose? How much can you make if you use these strategies? Simply time, which in trader speak, if we're, using the Greeks, they call that theta. Is time our friend or our enemy? Is it working for us or against it? And then we're going to draw it out. Okay, so what does it mean when I buy a call? Well, when I buy a call, it gives me the right to buy the stock or the underlying, it could be an index, it could be an ETF. Well, it gives me the right to buy at the strike price at any time from the time I place the trade up until expiration. What direction am I expecting that? I'm just going to use the stock to go. I'm expecting it to go up. Now, how much can I make and how much am I risking? Well, what I'm risking is 100%. I could lose the entire premium that I paid. So if I paid $2 to buy the call, I could lose all of it. Okay, so that's important to understand. So you don't want to, spend $1,500 to buy a call if, you have a $5,000 account. You're risking, too much. But how much can you make? Well, it's technically unlimited. It's an infinite number, or we could just say it's unlimited. Because who's to say how far that stock could go? It could gap up dramatically. Now, is time our friend when we're buying? It is not, because there's something called time decay, and every day that we're in the trade, it is ticking against us. Okay, so if I were to draw this out, what would it look like? Well, let's say we have a stock and it's been uptrending, and then it pulls back for a few days and it starts to go up again. We might say, you know what? I think this stock is going to continue to move to the upside. So I am going to buy a call right here. I'm going to buy a call. And let's say that call is, I'm going to buy the 50 strike. And I'm going to pay $2 for that. Now, if I am correct and the stock continues to move to the upside, and let's say it goes to 60, just to make the math easy for me, what is this call going to be worth? Well, remember, this is giving me the right to buy the stock at $50, right? So this has got to be worth $10, because if I come out, I could exercise my right to buy these shares at $50 and turn around and sell them for $60. And so how much would I have made here? Well, I'd have made $8 a share on a $2 investment. That's a 400% return. Sounds pretty sexy, right? This is when people start saying options, like, why did no one tell me that this was a possibility? Well, the other side of it is, like, what if we are mistaken? And there are times when things are not going to go your way. And what if it falls? Now, it could fall to 40, but it doesn't even have to fall to 40. What if it just fell to 48 and didn't come back? Well, this is going to become worth less and ultimately worth nothing. Like, so we could lose 100% of that premium. It could go to zero. And so this is where having some rules around position sizing and not risking more than you can afford to lose is important. And we're going to talk about that more, over the upcoming weeks. Okay. So now let's go move on to the put side, because we're going to have to move, relatively quickly with these. When I buy a put, what does that give me? Well, it gives me the right to sell the stock. And you know what, guys? When I first started, I found this confusing. So it gives me the right to sell. Okay, so when I buy a put, am I bullish or bearish? Well, bearish means you think the stock is going to go down. So this is a directional strategy where we think a stock might continue to fall. And how much are we risking? Well, again, we could lose 100% of what we paid to get in. And how much could we make? I used to just put the reward was potentially huge, and it is, but technically what we can make is the strike price minus what we paid to get into the trade. And I would write down what we paid to get into the trade because I think that's the easiest to understand, but I don't have enough room. So the debit we paid. So what we paid to get into the trade. So let's draw it out. So if we have, I just have to change my drawing tool. If we have a stock now that's not going up, it's going down, then it tries to rally for a few days. This is called a bear flag. And then it starts to fall again. I might say, okay, buying a call wouldn't work here, but I could buy a put. At this $50 level. And if things go according to plan, and let's say I'm just paying $2 for that, if things go according to plan and it falls as I'm expecting it to do, and let's have it go down to that 40 again, just to make the math easy. Well, what will this option be worth? Well, again, like the call, I have the right to sell it. So I could go out, buy 100 shares at $40 a share, and then turn around and sell it at 50. So one would imagine, that this has to be worth at least 10, and there could be some time value and other components to it. And again, how much would I have made there? That $8 a share, 400% return. So champagne corks are flying, there's dancing in the streets. But what if some kind of news comes out and this thing doesn't go the way I was expecting and it rallies instead? Well, this gives me the right to sell the stock at 50. What if it even just goes up to 55? Well, who's going to want to buy my put that gives them the right to sell it at 50 if it's trading above that? Not going to be so much interest, right? So this is going to become worth less and eventually worth nothing. And so again, we could lose it all. But if this fell really dramatically, we could have a pretty extraordinary return. Now, often when we place these trades, we'll put a target in. And sometimes that target, it could be aggressive, but sometimes we might just say, hey, this stock was trading at, I'm buying this call and I'm just going to trade it back up to the previous high. And so you could be looking for a small win. And we'll look at an example of that. Okay. I'm just looking over here at questions. Okay. So let's come back now and look at selling calls. Okay, so when we sell a call, we are now moving from rights to obligations. So we are saying when we sell a call, hey, if you would like to buy my stock from me at this price, at the strike, at any time between now and expiration, I am happy to sell it to you. And so some people might use this as a strategy to make some money on a stock they own that may be going sideways. Now, selling a call that isn't covered which is selling a naked call, we don't actually cover that topic in this class. But the net of it is we may be thinking that there's a short-term pullback coming, but ultimately we're bullish because if we're looking at selling a covered call, and I'm going to put covered here because we don't talk about selling naked calls as part of this series. If we aren't longer term bullish, then we may not want to continue to own the stock. But if we think that it may be going sideways for a while, and let me just draw that out. So let's say we have a stock that's doing some of this. You know, it's kind of trading in a range. And sometimes this happens. So what we could do, you know, and this is called resistance or the ceiling, and this is support or the floor. If you're new to charting, there's a class called Getting Started with Technical Analysis. It's taught on Tuesdays as well. And you may want to check that out. But we could sell a call right here, you know, when it comes up and bounces. If we have 100 shares of the stock, and then close it out or buy it back when it comes back here. And then when it comes back up, we could sell another one. And then when it comes down, we could close it out. And when it comes back up, we could, you know, wash, rinse, repeat. So this could be, you know, this is a covered call strategy. Now, what's our risk and what's our reward? Well, the reward is pretty easy. The reward is the most you can ever make on selling a covered call is the credit you get paid when you sell it. Now, what are you risking? Well, if you were to sell a naked call, which is why we don't do that, it's unlimited because it's hard. Let me say this. There is no limit to how high a stock can go. And we've seen some stocks that have gapped up in the last week, like Tesla, and kept running. And so if you had sold a call thinking the stock was going to go down, you could be in a world of hurt right now. You know, but if it is a covered call, then it's really, your risk is the opportunity cost. And I'm kind of going into the other category here. In other words, if you have a stock that's trading at, let's say this one is at $50, and you sell this call at 50, and then some kind of news comes out and it shoots up to 60, if you got paid $2 for that call, then, you know, if it goes above $52, you would have been better not to have sold the call. So you've missed out on that $8 worth of gain. But let's say this is the fourth time you've sold that call for $2, and every time you bought it back, I'm just making stuff up here. Let's say you bought it back for 50 cents, you know, you've earned some income. But if you are called out, you don't get to say like, hey, JK, I didn't really mean it. I didn't really want to sell the stock. Like if you get called out, you've sold the stock. And so if under no circumstances would you want to sell the stock, well, then you don't sell a covered call. Okay, but that's how that one works. And is time in our favor or working against us? Well, time is in our favor because we're selling something and we want it to go down in value. And every day as time goes on and time decay is chipping away, we wanted to sell something at a high price and buy it back at a low price. So sell it for $2, buy it back for 50 cents, or buy it back for 20 cents. You know, and on the put, time the same way with the call, it's not helping. Okay, now selling a put, that's our last one. So let's whip through this one. So when we're selling a put, are we creating an obligation? Yes, we are. And this time it's an obligation to buy. And you may say, well, hey, this is a put. So puts are are bearish, right? You're hoping the stock will go down. No, when we're buying a put, it's bearish. We're expecting the stock to go down. But when we're selling a put, we're saying, hey, we're willing to buy this stock at this strike at any time between now and expiration. We're expecting it to go up. How much can we make? Well, similar to the covered call, the most we can make is the credit we get paid to get in. How much could we lose? Well, like I'd like to say huge, but and it is a big number, but technically it's that strike minus the credit, minus what we were paid when we got in, because the stock technically could go to zero. You know, like if we are obligated to buy and the stock is put to us and then it continues to fall, you know, we could technically have a huge loss. Now, is time working for us? Yes, it is. So here's this example, if we're going to draw this out, and this is what I encourage you to do, or like if you're picking your kids up at a soccer practice and you're there 15 minutes early, grab a piece of paper and try and draw this out. And, you know, and you'll get pretty quick at it if you just keep doing this over time. But this is another bullish strategy where we see something going up and see something going up. Or it could be like this sideways strategy where it's been going sideways and then it breaks out to the upside. But you could say, okay, this is bouncing. It's now trading at 52. I am going to come in here and sell a put here. And it's a way of trying to maybe generate income. I'm just going to sell my put. I get paid my, you know, just to keep it consistent, my $2. And if the stock continues to go up, the further it gets above my strike, the less the strike is worth, because the lower the probability that the stock will end up being put to me. Okay, but the most I can make is this $200. And that's if I let it expire worthless. And so some might say, well, I'm not going to do that. I'm going to put it in order when I place the trade. And when I've got 80% or 90% of my max gain, I'm going to close this out. But you could end up owning it. And some people will do this as an ownership acquisition strategy. So they might sell their put up here where the odds of the stock being put to them where they end up owning it is higher. But technically, it could go all the way to zero. Even if that probability is low, it's a possibility. And then that's where you have this type of situation where, you know, you got paid $2, but, you know, if you sold this put at 50, what is technically your risk? $48 a share. Okay. How can we avoid getting assigned? Well, one of the ways to avoid getting assigned is to close out the position. Okay. If you get assigned, like, and it may not necessarily be a bad thing. Like your covered call, I do a class called Buy Right Covered Calls, where we're both buying the stock and selling a covered call at the same time. And I actually learned this from Cameron May, who's in the chat today. And our goal is for it to go through the strike and for us to be called out. And so if we're called out, that's a good thing. And if we're called out prior to expiration, even better, because then we've reached our max gain. Our goal was to be called out. So I'm just kind of giving you one variation on a theme here. But, you know, if you don't want to be assigned, then you close out the position. And if you are assigned, then, you know, I talk at length about what we can do should that happen. You know, it's too much for us to go over in the context of this introductory framework class. Okay. Can you demonstrate that for us? Okay. Yeah, we're going to do an example trade. So has everybody captured this information? And then I'd say capture it however you can, and then tomorrow or later today, grab a piece of paper and see if you can just draw this out yourself. Okay. And then compare, like, how close did you get to what I've drawn here? Okay, so I'm going to shake my Etch-a-Sketch. So here it goes. There we go. Okay, let's go out to the platform now. So, and I am going to bring up a JP Morgan. So here is JP Morgan, and oh, wouldn't you know it? So we can look at this stock. It's up 40% year to date. It gapped up last week, and then it's been consolidating. And so we can kind of come in here a little tighter, and we can see that this has been moving up. Now it's now down 8 cents, and this is a $240 stock. And when I first looked at this was up on the day. So let's just assume that this is the case, because I'd like to use this as our example. Let me just tidy this up. So here's an idea of buying a call. Now we could buy the stock and it would cost us about $23,926 to buy 100 shares. Or we could buy a call and say, hey, when it gets back up to this previous high of 248, in fact, we might just shave $1 off it and make it 247. We call that a swing trade. So we're just looking for the stock to swing back up to the previous high. And then we'd like to call it a day. Okay, so we are going to come out to JP Morgan. I'm going to put this in my other account. We're going to look at our trade tab. And if we're thinking like, hey, this came up and kind of pulled back for about 4 days, we're thinking likely in maybe a week, maybe it could take 2 weeks, but we don't think it'll take more than that. So do we want to come out and just buy 2 weeks worth of time? We don't. And why is that? Well, it's because time decay is chipping away every day at the value. And when you get in that 3 weeks to expiration time frame, time decay gets higher. And so we're going to come out to the December 20th expiration, which is the monthly. And we're just going to say, okay, I don't want to risk more than $500 on any one trade. So I could buy this first strike out of the money. It's costs between $425 and $435. And I want to buy this, and I know I could lose all of it. I'm going to put in a stop loss that if I lose 50%, I want to exit. But if this stock were to gap down dramatically, I could technically lose it all. And if we have an example trading plan, that might say, hey, I want to look at stocks that trade 1 million shares a day or more. I want the options to have a lot of volume also. And this is open interest, is the number of contracts that were on the books when the market opened today. Volume is how many people have bought and sold a call on JP Morgan that expires December 20th at the 245 strike. That's how many have traded today. And so we are going to buy, and we're going to buy custom, and we're going to put an OCO bracket on it. What does that mean? It's one cancels the other. And we want to sell this if it loses half its value. So we're going to put a stop in at 220. Whoops. And then we're going to put a target in, and we don't know quite what this option will be worth, but we're saying, hey, if this gets back up to 247, which is pretty close to, the previous high, we would like to sell this and take our profit. We're going to make both of these good till canceled. Now a market order, there's this little disappearing, reappearing sprocket. So I'm going to click on that. Where'd it go? Okay. I don't, sometimes these show up on different screens. Let me bring this up again. Now my screen has frozen. Oh, that's bizarre. Okay. What do the percentages? Yeah. Market, oh, change it to day. I can't change anything. My screen, it's frozen. Just see if yeah. Okay. I'm going to just, I can't delete it either. Okay, this is highly unusual. I've not had this happen. But you know what? We're going to, I just want to bring us back. I'll just bring us back to the PowerPoint then. So, but what, we should be able to hit this sprocket and put in that we want to exit this position when it reaches our target. And so somehow that isn't working for me at the moment. So we're going to come back and just wrap things up because I can't move my thinkorswim. And I wanted to show you a couple of other examples. If you were looking for a bullish example, you could look at WMT if you wanted something to practice on, which is Walmart, or Travelers, TRV. If you were looking for a bearish example, we could look at Boeing, which is ticker symbol. Let me just write these down. Seeing as you never know what's going to happen. We're live, right? So here's some bullish examples. If you wanted to go out and have a look, Travelers, TRV, Walmart. We were looking at JP Morgan, which is a financial stock. And then if you were looking for bearish, so if you were looking to maybe buy a put as an example, we could look at Boeing, which was falling today and which is down like over 40%, I think, year to date, or Merck. And so those are just some examples that you could use to practice. And so that actually will be a wrap for us today. What I would love for you to do is go back to that crazy screen that we corrected, that we created together. And yeah, somebody said try. Let me just bring it up and try. We're pretty much out of time here. Yeah. Yeah. So here's my ask as we wrap things up today. There is a survey in the chat. So technical issues aside, if you click on that link, there are two questions. One is I hated it. 10 is I loved it and I'm going to keep coming back. And then there's everything in between. There's also the ability to put comments in. So if you'd like to put in a comment, my promise to you is if you type in a comment, I promise to read it, and so will the management team. If you hit the like button, it is snowing here in Salt Lake City today. So if you decide to go outside, here's a chance to do a favor for a random stranger without leaving the house, because it moves things up in the algorithms on YouTube so that more people can find this content. So hitting the like, comment, and as Cameron May said, it sounds like applause to us. So it lets Cameron and I know that you thought we did a great job. So hit the like button. If you haven't subscribed to this channel, somebody had watched one of the classes in this series last week, the 7 things I wish I'd known about trading, when I started. And he said, like, how do I find the rest of the series? Well, if you subscribe, it makes it very easy to find this content again. And it's a free resource. And last but not least, you want to follow us in the land of X. So my handle, Barb Armstrong CS, Cameron May CS. So guys, that's a wrap. Thank you so much for joining us today. If you're watching this in the archives, if you've got questions, you can just type them in below. I'll get back to you quickly. Cameron, thanks for answering all the questions that you did. I can see that they had you pretty busy today. And thanks to the guys behind the scenes for making this look so polished in spite of our hiccup with thinkorswim. Take care. Have an awesome day. Up next is trading flag patterns. And then following that will be that getting started with technical analysis. Take care, everyone. Bye for now.